Hi everybody. In this video I'm going to describe the simple moving average model and how it gets used in the area of finance and some areas of economics. In general, a moving average model is just simply the calculation of the unweighted means of the previous n data points. For example, if we were going to try to calculate the moving average forecast for next period, say f sub t plus 1, then what we would do is we would add up all the values of the variable that we want to forecast x from period t all the way to period t minus 9 and divide by 10. This would give us the moving average forecast for next period. Likewise, the moving average forecast for this period would have been x sub t minus 1 all the way back to x sub t minus 10, summed up and again divided by 10. And this is for the example of a 10-period moving average. And what you should notice here is that the window of the forecast incorporates everything for f sub t between t minus 1, period t minus 1, all the way back to t minus 10. But once we move into the next period forecast, f sub t plus 1, we drop off the value x sub t minus 10, and we add on the value, the more recent value of x sub t. And so the window is constantly moving forward as we're calculating that mean. Let's create a simple moving average model using real data. Remember that simple moving average model is calculated by taking the arithmetic mean of a given set of values. And since we're doing a 10-period moving average, we're going to select a stock that we're all familiar with. Our example is going to use that stock price to calculate a basic 10-day moving average for this stock price. And all we're going to do is add up the closing prices from the past 10 days and then divide the result by 10 and repeat that process throughout the data set. Now suppose we download Apple computers and we collect the adjusted closing price and create that 10-day moving average. How would we do that? Well, first we need to collect the stock information. You do that by going to Yahoo Finance, search for Apple stocks, and then select this button above the graph for Apple stocks, which says historical data. When you click on that, it's going to give you another screen, and from that screen you're going to click on the download data button. And you can select as much data as you like, going all the way back to the beginning of Apple. And what you'll get is the ability to open up Apple stock prices, the adjusted closing price going back for quite a long ways. And the reason that we use adjusted closing price is that it adjusts for splits and changes that have happened to the stock over time. Once we've downloaded it, we can open it up in Excel, and you can see that the adjusted closing price has values that are in the $150 to $160 range. It also has information about the volume. And this information here, I've included myself. And so I'm just putting in the number that's associated with each one of those different observations of the data. And I'm going to compute the 10-day moving average forecast for the adjusted close. And so the first value of that moving average forecast appears in the 11th cell down from the top. And so you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11th cell, and we take the average of the values that are in F2 to F11. So here's F2 all the way down to F11, right there. Okay? Once we've done that, that average is computed, and the average is 161.19, rounded. And then we repeat that process by copying down the column until we're finished, all the way to the bottom. And that last value that we don't have an actual value for becomes the first period of our forecast. And so here we've calculated the 10-day moving average forecast for Apple stock prices. And to the right is a graph of Apple adjusted closing prices along with its 10-day moving average forecast. And what you can see is that currently that 10-day forecast, 10-day moving average forecast lies above the actual price of the stock. The actual price of the stock appears to be falling, and the moving average has crossed over from beneath and moved above, and now is being pulled down by the actual value of the stock price. One of the main reasons we use moving averages is to try to smooth out short-term fluctuations and highlight longer-term trends in the data. The point is to get rid of the rapid up and down movements that appear that are random and try to find that underlying smooth line that runs throughout the middle of the data. Another example in economics, we use moving averages to examine things like gross domestic product, employment, unemployment insurance claims, and other macroeconomic time series variables. Moving averages are probably most widely known to be used in finance. It's widely used as an indicator in technical analysis, and these indicators help smooth out price actions by filtering out the noise from the random up and down motions that happen in prices of stocks. A moving average is a trend that follows or lags behind the stock price, so it's considered a lagging indicator because it's based on past prices. And one of the main reasons they're used in finance, they can be used as a signal of momentum shifts in stock prices or rates of return. So consider this. If you see a stock price that you think the momentum has shifted in a downward direction, this means that you think that the price is going to fall over time. This may be an indication that you want to trade out of that particular stock. Here's an example of how we use those moving averages as a momentum shift signal. So we're looking at Apple stock, and they're adjusting, and it's adjusting closing price over that 10-day moving average forecast. So where we see the orange line pass above the blue line, this is where the moving average has cut from below to above the actual stock price. What this means is that the price of the stock is falling faster than the moving average, and it's pulling the moving average down. And so some stockbrokers and stock traders consider this an indication of a momentum shift in the downward direction, which signals that they should be starting to sell off these shares of Apple. On the other hand, I just drew these two lines in, but you could see if it moved back in the other direction. Suppose that the actual price of Apple stock moved back above the moving average for a period. This would provide the opposite indication. It would signal positive momentum in the stock price, and this would be an indicator that you probably want to buy back into Apple stock. Although moving averages are useful on their own, they also form the basis of indicators for things like moving average convergence divergence models. These models rely on the relationship between moving averages of different lengths calculated over the same series of data, usually time series data, obviously. What you use is combinations of different moving averages. So these combinations, they end up giving you information about trading signals, whether or not you should be buying or selling. Upward momentum may be confirmed when a short-term moving average crosses above a longer-term moving average. Conversely, downward momentum may be confirmed when a short-term moving average crosses below a longer-term moving average. And I'm going to show you a picture of this. And as a further indication of the usefulness of the moving averages, Yahoo Finance allows you to calculate some of these moving averages directly in the graphs that they produce for you online. So they consider this a helpful tool for people who are making investment decisions. And here I've created the 20-day moving average along with a 50-day moving average. Now note, I've just put these moving averages together. I'm not providing stock market investment advice here. And so if you compare the 20-day moving average with the 50-day moving average, you can see these crossover points. And everywhere we have the moving average, the 20-period moving average cutting below or falling below the 50-period moving average, this is an indication that we probably ought to be selling the stock. And so here's a period where if you were using this crossover point as an indicator of a sale, you would have sold out of Apple. Again, a few weeks or months later, the 20-period moving average cut above the 50-period moving average, and this signals upward momentum. And so in this case, you would have bought Apple stock. And what you see is that there's no crossover points anywhere in the series going all the way up for almost, if not a little more than a year. And the next crossover point where the moving average cuts back below the 20-period moving average cuts back below the 50-period moving average is after a period of a few weeks of, or maybe even a month of downward movement in the stock prices and downward movement in the 20-period moving average. And so again, in this area right here, as this green line goes down below the red line, the pinkish red line, this is an indication that we probably want to sell out of Apple stock. And then there's another momentum shift again. And yet again, we get a place where the 20-period moving average cuts above the 50-period moving average. And this is an indication that we want to buy back in. So keep in mind that even though moving averages are considered to be useful in the process of investing, the information I provided shouldn't be interpreted as an endorsement of a particular methodology. Thanks for listening.